The IRS lets you put $72,000 a year into your retirement account. Not $24,500, $72,000. And almost nobody at your company is going to tell you about the extra $47,500 of tax-free space sitting on the table. Here's the question we're answering today. If the official 401k contribution limit for 2026 is $24,500, why does the IRS rulebook quietly authorize an annual cap of $72,000? Where does that extra $47,500 come from? Who's allowed to use it? And what is it actually worth over a 30-year career? We pulled the numbers directly from IRS Notice 2020-567, cross-referenced plan availability data from Vanguard's How America Saves 2025 report and the PSCA Annual Survey, and modeled 30 years of compound growth to put a real dollar figure on the gap. The strategy has a nickname, the Mega Backdoor Roth, and it's not a gray area trick. It's explicitly sanctioned by IRS Notice 2014-54. The catch is that your employer has to turn it on, and most don't advertise it when they do. Start with the limits everyone knows, and the limits almost nobody knows. In 2026, the employee deferral limit, the one HR sends you an email about every January, is $24,500. That's the 402G limit. But there's a second IRS limit that governs the total amount that can land in your 401k account in a single year from all sources combined. That's the 415C limit, and for 2026, it's $72,000. Subtract the two, $72,000 minus $24,500 equals $47,500 of additional contribution space. That space is filled by employer match, plus a category most workers have never heard of, called after-tax contributions. Not Roth contributions, after-tax, they're different, and that distinction is the entire game. Here's the mechanic in 3 steps. Step 1, you max your regular 401k deferral at $24,500, pre-tax or Roth, your choice. Step 2, after that bucket is full, you make after-tax contributions, with money that's already been taxed, up to the $72,000 ceiling minus your employer match. With no match, that's a clean $47,500 of additional space. Step 3, and this is the part that turns it from good to extraordinary, you immediately convert those after-tax dollars into a Roth account, either inside the plan or by rolling them out to a Roth IRA. After the conversion, the money grows tax-free forever. No tax on the gains, no required minimum distributions on the Roth IRA portion, no tax in retirement. The IRS greenlit this exact sequence in Notice 2014-54, which clarified that after-tax contributions can be isolated and converted without triggering the pro rata rule that normally complicates IRA conversions. Now the part you came for. Take a 35-year-old with a 30-year horizon to age 65. Assume a 7% nominal annual return, which is a standard long-run equity assumption. Scenario 1, they max only the standard 401k at $24,500 a year. After 30 years, that account grows to roughly $2.31 million. Scenario 2, they max the full $72,000 a year using the Mega Backdoor Roth. After 30 years, the account grows to roughly $6.8 million. The gap, $4.49 million, all of it tax-free at withdrawal. Now compare that $4.49 million to what you'd have if you'd saved the same after-tax dollars in a regular taxable brokerage account. Apply a blended 20% long-term capital gains rate plus the 3.8% net investment income tax on roughly $3.06 million of growth, then add the annual drag from taxes on dividends and distributions over 30 years. The lifetime tax savings versus a taxable account easily exceeds $1.4 million, and for high earners in high-tax states, it can approach $2 million. These projections are estimates modeled at a constant 7% return, and your actual returns will vary. But the structural advantage, tax-free compounding on an extra $47,500 a year, is real regardless of what the market does. If this is so powerful, why isn't it on the front page of every benefits portal? 3 reasons. First, plan availability. Vanguard reports that 86% of plans now offer a standard Roth 401k option. But only around 22% of plans offer the specific combination required for the Mega Backdoor, after-tax contributions plus in-service conversions or distributions. That's the bottleneck. Big tech companies, Google, Microsoft, Amazon, Meta, Apple, Nvidia, almost all offer it. Most mid-market and small employers do not. Second, even when plans offer it, only 18% of eligible participants elect even the basic Roth option, according to Vanguard 2024 data. Awareness is low. Third, the operational friction. Payroll systems often default after-tax contribution elections to off. Benefits reps frequently confuse after-tax with Roth and give wrong information. You usually have to explicitly request the feature, set the contribution percentage yourself, and trigger the conversions manually unless your plan automates them. Congress also nearly killed this strategy in 2021. The original Build Back Better bill included language banning after-tax to Roth conversions starting in 2022. It died in the Senate. The Mega Backdoor survived by political accident. Here's the decision framework. Step 1. Pull up your plan's summary plan description and search for 2 specific phrases. After-tax contributions, not Roth contributions, those are different, and in-service distributions or in-plan Roth conversion. If both phrases appear, your plan supports the Mega Backdoor. If only one appears or neither, it doesn't. Step 2. If you have the feature and your household income is above roughly $200,000 single or $350,000 joint, run this order of operations. Max the employee deferral at $24,500 and capture the full employer match first. Max your HSA, $4,400 single or $8,750 family in 2026. Max a backdoor Roth IRA at $7,500. Then route everything else into after-tax 401k contributions up to the $72,000 ceiling. Step 3. Convert the after-tax balance to Roth as fast as your plan allows, ideally same-day automatic conversion, because every day those dollars sit in the after-tax bucket, any earnings become taxable at conversion. Step 4. If your plan doesn't offer the feature, formally request it from HR and benefits. PSCA data shows adoption is growing 3 to 5 percentage points per year, driven almost entirely by employee demand. One more thing to know. Starting January 1, 2026, Secure 2 requires that employees with prior year FICA wages above $145,000 must make their age 50-plus catch-up contributions as Roth. So if you're over 50 and a high earner, part of your retirement savings is going Roth, whether you plan for it or not. If this kind of analysis is useful to you, hit like and subscribe so we can keep doing the math so you don't have to. Thanks for watching.